Question 1. An insured purchased a 10-year level term life insurance policy. What characteristic is true about this type of policy? A. The premium will increase annually over the 10-year period. B. It builds cash value that can be borrowed against. C. The death benefit remains constant for the 10-year period. D. It provides coverage for the insured's entire life. Answer: C. The death benefit remains constant for the 10-year period. A 10-year level term life insurance policy provides a fixed death benefit for a specific period, which in this case is 10 years, and the premiums usually remain level throughout that term. Unlike permanent insurance, term life policies do not build cash value and are designed to provide coverage for a defined temporary need, such as protecting income during a mortgage repayment period. This type of policy offers simplicity and affordability by only providing coverage for a limited time. Always remember that term insurance means coverage for a specific period, and level indicates the death benefit stays the same. Question 2. All of the following are typically considered non-forfeiture options in a whole life insurance policy, except A. Cash surrender value. B. Extended term. C. Reduced paid-up insurance. D. Automatic premium loan. Answer: D. Automatic premium loan. Non-forfeiture options protect policy owners from losing their accumulated cash value if they surrender or stop paying premiums on a permanent life insurance policy. The three standard non-forfeiture options are cash surrender value, extended term insurance, and reduced paid-up insurance. An automatic premium loan is a policy provision or rider that uses the policy's cash value to pay an overdue premium, preventing policy lapse, but it is not considered a non-forfeiture option itself. Understanding these distinct options helps ensure a policy's value is not entirely forfeited. Question 3. An insured dies 5 years after purchasing a life insurance policy, and it is discovered that the insured intentionally misrepresented material facts on the application. Which policy provision prevents the insurer from denying the claim based on these misrepresentations? A. Entire contract clause. B. Grace period. C. Incontestability clause. D. Reinstatement provision. Answer: C. Incontestability clause. The incontestability clause states that, after a policy has been in force for a specific period, usually 2 years, the insurer cannot contest the validity of the policy, even if there was a material misrepresentation on the application. This provision protects the beneficiaries, ensuring that the death benefit will be paid without dispute after the contestable period has passed. It provides a sense of security that the policy will indeed pay out when needed, assuming the policy remains in force beyond that initial period. Think of it as a time limit for the insurer to discover any application inaccuracies. Question 4. Which of the following statements regarding the taxation of life insurance death benefits is generally true? A. Death benefits are typically taxable income to the beneficiary. B. Death benefits are generally received income tax-free by the beneficiary. C. Death benefits are taxable only if the policy owner paid the premiums. D. Death benefits are subject to federal income tax but exempt from state income tax. Answer: B. Death benefits are generally received income tax-free by the beneficiary. One of the most significant advantages of life insurance is that the death benefit paid to the beneficiary upon the insured's death is typically received income tax-free. This means the full amount of the policy proceeds can be used by the beneficiary without being reduced by income taxes. While there can be estate tax implications for very large estates, for most individuals, the income tax-free nature of the death benefit is a key feature. Remember this crucial tax advantage when discussing the benefits of life insurance. Question 5. An insured has a universal life policy and wants to access some of the policy's cash value without terminating the policy. Which of the following methods allows them to do this? A. Policy surrender. B. Policy loan. C. Extended term option. D. Reduced paid-up option. Answer: B. Policy loan. A policy loan allows the policy owner to borrow money from the cash value of a permanent life insurance policy, such as a universal life policy, without terminating the policy. The loan accrues interest and, if not repaid, will reduce the death benefit payable upon the insured's death. Surrendering the policy would terminate coverage, while extended term and reduced paid-up are non-forfeiture options used when premiums are stopped. Taking a policy loan offers a flexible way to access funds while keeping the insurance coverage active. Question 6. What is the primary purpose of the Medical Information Bureau, MIB? A. To provide an applicant's full medical history to all insurers. B. To allow insurers to share information about an applicant's health and underwriting results. C. To act as a clearinghouse of medical information to help insurers detect misrepresentations and fraud. D. To conduct medical exams for insurance applicants. Answer: C. To act as a clearinghouse of medical information to help insurers detect misrepresentations and fraud. The Medical Information Bureau, MIB, is a non-profit trade organization that collects and shares coded health information about individuals who have applied for life or health insurance. Its primary purpose is to serve as a fraud detection tool, helping insurers identify potential misrepresentations or omissions on applications without sharing full medical records. The MIB does not provide detailed medical histories or conduct exams. Instead, it alerts insurers to potential discrepancies that may warrant further investigation. It helps insurers protect against adverse selection, which is when applicants with higher risks try to obtain coverage without revealing their true health status. Question 7. Which life insurance policy rider would pay the policy's death benefit if the insured suffered a critical illness, such as a heart attack or cancer, and met the rider's conditions? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Living benefits, accelerated death benefit, rider. Answer: D. Living benefits, accelerated death benefit, rider. A living benefits, or accelerated death benefit, rider allows an insured to receive a portion of their life insurance policy's death benefit while still alive, typically if they are diagnosed with a terminal illness, a critical illness, or require long-term care. This provides financial relief during a challenging time when funds might be needed for medical expenses or other costs. Other riders like waiver of premium, accidental death benefit, and guaranteed insurability serve different purposes related to premiums, accidental death, and future insurability, respectively. This rider offers a crucial safety net for severe health crises. Question 8. A policy owner decides to stop paying premiums on her whole life policy and wants to receive a lump sum payment of her accumulated cash value. Which non-forfeiture option should she choose? A. Reduced paid-up insurance. B. Extended term insurance. C. Cash surrender value. D. Automatic premium loan. Answer: C. Cash surrender value. The cash surrender value non-forfeiture option allows a policy owner to terminate their permanent life insurance policy and receive the accumulated cash value as a lump sum payment. Choosing this option effectively ends the policy's coverage. Reduced paid-up and extended term insurance are other non-forfeiture options that continue some form of coverage, while an automatic premium loan is a different policy feature. If a policy owner simply wants their money back and to end the policy, cash surrender value is the direct method. Question 9. Which of the following is characteristic of a universal life insurance policy? A. Fixed premiums and fixed death benefit. B. Premiums are paid into a separate account and invested in subaccounts. C. Flexible premiums and adjustable death benefit. D. Coverage for a specified period with no cash value accumulation. Answer: C. Flexible premiums and adjustable death benefit. Universal life insurance is known for its flexibility, allowing policy owners to adjust both the amount and frequency of their premium payments and the death benefit amount within certain limits. This flexibility contrasts with traditional whole life insurance, which has fixed premiums, or term life, which offers no cash value. The policy's cash value growth is interest sensitive, and the policy owner can use it to pay future premiums or take loans/withdrawals. This adaptability makes universal life suitable for those whose financial needs may change over time. Question 10. All of the following are legitimate uses of key person life insurance, except A. To protect a business from financial loss due to the death of a valuable employee. B. To provide a retirement income for a key employee. C. To help the business recover from lost sales or opportunities if a key person dies. D. To fund the cost of finding and training a replacement for a key employee. Answer: B. To provide a retirement income for a key employee. Key person life insurance is designed to protect a business financially from the economic loss that would result from the death or disability of an important employee. The business is the policy owner, pays the premiums, and is the beneficiary, using the funds to offset losses from reduced sales, disrupted operations, or the cost of finding a replacement. Providing a retirement income for a key employee is a separate benefit or plan, not the direct purpose of a key person life insurance policy. This type of insurance ensures business continuity during unforeseen personnel challenges. Question 11. An agent suggests that a client replace an existing life insurance policy with a new one that offers slightly better benefits but involves higher initial costs and a new contestability period. This practice could be considered A. Conservation. B. Replacement. C. Twisting. D. Conversion. Answer: C. Twisting. Twisting is an illegal practice where an agent persuades a policy owner to lapse or surrender an existing life insurance policy to purchase a new one, to the client's detriment. This often involves misrepresenting the benefits, advantages, or disadvantages of the new or existing policy. While replacement is the act of buying a new policy and surrendering an old one, which can be legitimate if done properly, twisting specifically refers to the unethical and illegal inducement to do so. Regulators strictly monitor this practice to protect consumers from unnecessary financial harm. Question 12. A policy owner names his 3 children as beneficiaries, specifying that if one child predeceases him, that child's share will be distributed equally among their own children, the grandchildren. This is an example of which type of beneficiary designation? A. Per capita. B. Revocable. C. Irrevocable. D. Per stirpes. Answer: D. Per stirpes. A per stirpes, Latin for, by branch, beneficiary designation means that if a named beneficiary dies before the insured, that beneficiary's share of the death benefit will pass to their living descendants, their children. In contrast, per capita, by head, would mean the death benefit is divided equally only among the surviving named beneficiaries. Per stirpes ensures that the share intended for a deceased family branch is inherited by that branch's next generation, providing for family lineage. It's crucial for estate planning to ensure the desired distribution of assets. Question 13. Which of the following statements about the grace period in a life insurance policy is correct? A. It is typically 7 days for all policies. B. It allows coverage to continue for a short period after a premium due date without payment, preventing immediate lapse. C. During this period, the policy has no cash value accumulation. D. Claims filed during the grace period will be denied. Answer: B. It allows coverage to continue for a short period after a premium due date without payment, preventing immediate lapse. The grace period is a provision in a life insurance policy that allows the policy owner an additional period, typically 30 or 31 days, beyond the premium due date to pay the premium without the policy lapsing. During this time, the policy remains in force, and if the insured dies, the death benefit will be paid, less any unpaid premiums. This provision prevents immediate lapse and provides a safety net for policy owners who might be slightly late with a payment. Always remember the grace period gives you a little extra time to keep your coverage active. Question 14. An individual purchases a whole life insurance policy. Which of the following statements is true regarding this type of policy? A. Premiums typically increase annually over the life of the policy. B. It provides coverage for a specific period, usually 10 or 20 years. C. It builds cash value that the policy owner can access during their lifetime. D. The death benefit is variable and dependent on market performance. Answer: C. It builds cash value that the policy owner can access during their lifetime. Whole life insurance is a type of permanent life insurance that provides coverage for the insured's entire life and accumulates a guaranteed cash value over time. This cash value grows tax-deferred and can be accessed by the policy owner through policy loans or withdrawals during the insured's lifetime. Unlike term life, whole life premiums usually remain level, and the death benefit is generally fixed. The cash value component is a key distinguishing feature, offering both a savings element and a death benefit. Question 15. A life insurance policy's free look provision allows the policy owner to A. Review the policy for 30 days and return it for a full refund if not satisfied. B. Pay premiums for a limited period before the policy becomes paid up. C. Adjust the death benefit amount without underwriting. D. Access the cash value without incurring any surrender charges. Answer: A. Review the policy for 30 days and return it for a full refund if not satisfied. The free look, or right to examine, provision gives the policy owner a specific period, usually 10 or 20 days, or 30 days for seniors, from the date the policy is delivered to review its terms and conditions. If they decide they don't want the policy for any reason, they can return it to the insurer for a full refund of all premiums paid. This ensures consumers have time to understand what they've purchased and are satisfied with their decision. Always take advantage of the free look period to ensure the policy meets your expectations. Question 16. What is the primary characteristic of a variable life insurance policy? A. Fixed premiums and a guaranteed cash value. B. A death benefit that fluctuates based on the performance of a separate account. C. Flexible premiums and a minimum guaranteed interest rate on cash value. D. No cash value accumulation. Answer: B. A death benefit that fluctuates based on the performance of a separate account. Variable life insurance is characterized by its death benefit and cash value being tied to the performance of investment subaccounts chosen by the policy owner. These subaccounts are held in a separate account and are not guaranteed. While there's typically a minimum guaranteed death benefit, the actual death benefit and cash value can increase or decrease based on market performance, introducing investment risk for the policy owner. Due to this investment component, selling variable life insurance requires both a life insurance license and a securities license, FINRA Series 6 or 7. Question 17. The policy provision that states the policy document, application, and any attached riders constitute the entire agreement between the policy owner and the insurer is known as the A. Insuring clause. B. Entire contract clause. C. Consideration clause. D. Owner's rights clause. Answer: B. Entire contract clause. The entire contract clause stipulates that the life insurance policy itself, along with the application and any attached riders or amendments, constitutes the complete and entire agreement between the applicant and the insurer. This means that nothing outside of these documents can be used to modify or dispute the policy's terms. This provision protects both the policy owner and the insurer by ensuring that all relevant terms are in writing and part of the contract. It prevents either party from referring to outside agreements or oral statements to alter the policy. Question 18. An insured named his spouse as the primary beneficiary and their 2 children as contingent beneficiaries. If the spouse predeceases the insured, who will receive the death benefit upon the insured's death? A. The insured's estate. B. The 2 children, equally. C. The spouse's estate. D. The insurer retains the funds. Answer: B. The 2 children, equally. In a beneficiary designation, the primary beneficiary is the first in line to receive the death benefit. If the primary beneficiary predeceases the insured, the death benefit will then be paid to the contingent beneficiaries. In this scenario, since the spouse, primary beneficiary, died before the insured, the death benefit would pass to the 2 children, who are named as contingent beneficiaries. This structure ensures that there is always a backup plan for who receives the policy proceeds. Always review and update beneficiary designations regularly to reflect current wishes. Question 19. An insured becomes totally and permanently disabled and can no longer pay their life insurance premiums. Which rider would most likely pay the premiums on their behalf? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Waiver of premium rider. D. Cost of living adjustment, COLA, rider. Answer: C. Waiver of premium rider. The waiver of premium rider is a valuable life insurance rider that protects the policy by waiving premium payments if the insured becomes totally and permanently disabled before a certain age. This means the policy remains in force, and the death benefit and cash value continue to grow as if premiums were still being paid. This rider provides crucial financial relief during a time of significant hardship. It's a key benefit to consider for anyone concerned about maintaining coverage during long-term disability. Question 20. Which life insurance non-forfeiture option provides the original amount of coverage for a reduced period of time? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Automatic premium loan. Answer: C. Extended term insurance. The extended term insurance non-forfeiture option uses the policy's cash value to purchase a single premium term life insurance policy for the original face amount of the permanent policy. The coverage will last for a specific period determined by the amount of the cash value, after which it expires. This option provides the maximum death benefit for the longest possible duration without further premium payments. It's often the default non-forfeiture option if no other choice is made. Question 21. What is the main difference between a qualified retirement plan and a non-qualified retirement plan regarding taxation? A. Qualified plans are funded with after-tax dollars, while non-qualified plans are funded with pre-tax dollars. B. Qualified plans offer tax-deductible contributions and tax-deferred growth, while non-qualified plans do not. C. Qualified plans are only available to employees, while non-qualified plans are for business owners. D. Qualified plans have no contribution limits, while non-qualified plans have strict limits. Answer: B. Qualified plans offer tax-deductible contributions and tax-deferred growth, while non-qualified plans do not. The primary distinction between qualified and non-qualified retirement plans lies in their tax treatment and ERISA compliance. Qualified plans, like 401(k), S or IRAs, meet IRS and ERISA requirements, allowing contributions to be tax-deductible, pre-tax, and earnings to grow tax-deferred until withdrawal, where they are then taxed as ordinary income. Non-qualified plans, conversely, do not meet these federal requirements and typically do not offer upfront tax deductions for contributions, though earnings may still grow tax-deferred. Think of qualified as meaning IRS approved for special tax benefits. Question 22. The purpose of a suicide clause in a life insurance policy is to: A. Prevent the payment of the death benefit if the insured commits suicide within a specified period. B. Increase the death benefit if the insured commits suicide after a specified period. C. Force the insurer to pay the death benefit regardless of the cause of death. D. Automatically pay the death benefit if suicide is committed within the first year. Answer: A. Prevent the payment of the death benefit if the insured commits suicide within a specified period. A suicide clause is a standard provision in most life insurance policies that states if the insured commits suicide within a specified period after the policy's effective date, usually 1 or 2 years, the insurer will not pay the death benefit. Instead, they will typically only refund the premiums paid. If the suicide occurs after this exclusion period, the full death benefit will be paid. This clause is designed to protect insurers from individuals buying a policy with the intent of committing suicide. Question 23. A prospective policyholder is considering purchasing a life insurance policy and wants to ensure that the policy's cash value grows at a rate linked to a stock market index, but with a guaranteed minimum interest rate. Which type of policy would best fit this description? A. Variable universal life. B. Whole life. C. Indexed universal life. D. Term life. Answer: C. Indexed universal life. Indexed universal life, IUL, insurance is a type of universal life policy where the cash value growth is tied to the performance of a recognized stock market index, like the S&P 500, but with a guaranteed minimum interest rate, often zero, preventing losses during market downturns. It typically also has a cap on potential gains. This offers a balance of market participation potential with downside protection, unlike variable universal life which carries full investment risk. It combines the flexibility of universal life with an interest crediting method tied to an index. Question 24. A policy owner has an existing life insurance policy and wants to exchange it for a new policy with a different insurer. The regulations governing this transaction are primarily concerned with A. Ensuring the new policy has a higher death benefit. B. Protecting the policy owner from potential disadvantages of replacement. C. Minimizing the commission paid to the new agent. D. Requiring a new medical exam for the replacement policy. Answer: B. Protecting the policy owner from potential disadvantages of replacement. Regulations governing policy replacement are primarily designed to protect the consumer from potential disadvantages, such as new waiting periods, like the incontestability and suicide clauses, higher premiums due to increased age, surrender charges on the old policy, or loss of existing benefits. Insurers and agents are required to provide specific disclosures and comparisons to ensure the policy owner makes an informed decision about replacing coverage. The focus is on consumer protection, not on agent commission or mandating specific policy features. Question 25. Which life insurance policy dividend option uses the dividends to purchase additional small, single premium policies of the same type as the original policy? A. Cash option. B. Reduction of premium option. C. Paid-up additions option. D. One-year term option. Answer: C. Paid-up additions option. The paid-up additions dividend option uses any declared dividends to purchase small, single-premium whole life insurance policies. Each addition increases the policy's death benefit and accumulates its own cash value, enhancing the overall policy's value. This option allows the policy owner to effectively increase their coverage without proving insurability or paying additional regular premiums. It's a common way to build both death benefit and cash value over time.